On a tax return, not everything you buy becomes a depreciable asset. Some things are materials and supplies, and they're usually deducted when you use them or consume them in the business. On the EA exam, they love testing the timing, not when you buy it, but when it's actually used. And yes, some expensive items still qualify if they're used up fast enough. Here are the main categories you need to recognize. First, any unit of property that costs $200 or less. Second, 12-month property. Anything with a useful life of 12 months or less, regardless of cost. Third, acquired components like spare parts and filters used to maintain equipment. Then, incidental supplies you don't really track, like pens and toner. And consumables like fuel and lubricants expected to be used up within 12 months once operations start. The core rule is simple. Materials and supplies are deducted in the year they're used or consumed. That's the default timing rule you should hear in your head on exam day. If you buy supplies in December but don't use them until January, the deduction generally follows the use. Incidental supplies are the common exception. If you don't track them and they're not significant, they often get expensed as purchased under the reg's practical approach. Now for the fun part. Expensive items can still be deducted now if they meet the 12-month property rule. Think of a manufacturing blade that costs $6,750 but wears out every 3 to 4 months. Even though it's pricey, it's still a supply because its useful life is under a year. That means it's deductible when consumed. This is a classic EA exam trap. Don't assume expensive automatically means capitalize. Materials and supplies also interact with the de minimis safe harbor. De minimis is about expensing based on a dollar threshold and accounting policy, and it generally requires an election statement when used as the de minimis safe harbor. But there's a separate point students miss. Deducting materials and supplies when used or consumed does not require a statement. So if the fact pattern says no statement attached, that doesn't kill a materials and supplies deduction. Finally, know what's excluded. Materials and supplies is not a way to expense inventory. Inventory flows through cost of goods sold, not supplies expense. And land is never part of de minimis expensing. Land isn't depreciable, and you don't get to expense it. On the EA exam, if you see inventory or land, your materials and supplies instincts should turn off immediately. Which of the following is not an acceptable inventory method for federal tax purposes? The choices include an allocation method, LIFO, specific identification, and FIFO. Think about which one is not a real tax inventory method, even if it sounds reasonable in plain English. Think about it. The correct answer is the allocation method. FIFO, LIFO, and specific identification are all recognized inventory methods. Allocation method is the tempting one because businesses allocate costs all the time, but it's not a standard IRS inventory method name. On exam day, stick to the classic trio: FIFO, LIFO, and specific identification. Marisol is a Schedule C direct seller with perfume inventory. During the year, she takes $250 of perfume out of inventory for her own personal use. She says she'll wear it when visiting clients. What's the proper tax treatment? The options include reducing purchases, increasing purchases, deducting on Schedule A, or deducting on Schedule C as promotion. Think about it. The correct answer is to reduce total inventory purchases by $250, or otherwise adjust COGS for the personal withdrawal. Personal use is not a business deduction, even if she wears it around clients. The tempting wrong answer is calling it a promotional expense on Schedule C, but the key fact is she removed inventory for personal use, so it can't stay in cost of goods sold.